In January 2019, a company called the We Company was valued by its private investors at $47 billion. By October of that same year, roughly 9 months later, a fair estimate of its worth was somewhere near $8 billion. No factory had burned down. No fraud indictment had been filed. No competitor had launched a better product. The company lost $39 billion of paper value simply because outsiders were finally allowed to read the documents. So what happened? How does a company shed $39 billion without anything physically changing about the business itself? No asset was destroyed. No demand evaporated. The desks were still occupied the entire time. The answer is one of the cleanest case studies in modern finance of a single specific trick: selling a real estate company as a technology company, and then having that classification tested in public by people who could finally do the arithmetic. This is Market Cap Stories. Today, the collapse of WeWork and the 6 weeks in which a $47 billion story met its own balance sheet. Let's start with the business itself, stripped of all the language. WeWork's core operation was extraordinarily simple. It signed long-term leases on large amounts of commercial office space, typically 10 to 15-year commitments with major landlords. It then spent money renovating that space: glass partitions, reclaimed wood, communal kitchens, free coffee, beer on tap. Then it sublet that same space, short-term, by the month, sometimes by the day, to freelancers, small startups, and eventually large corporate tenants. That is the entire model. Sign long leases, renovate, sublet short. The economic value WeWork created was real. It bought space wholesale in 15-year blocks and sold it retail in 1-month slices, absorbing the duration risk and the build-out cost that a freelancer could not. That is a legitimate service. It is also an old one. If the model sounds familiar, it should. It is the exact business of a company called Regus, later rebranded IWG, which had been doing precisely this in dozens of countries since 1989. WeWork did not invent the flexible office. It inherited it and redecorated it. Here's the first thing an analyst would notice. WeWork's model has a structural flaw baked directly into it. A flaw so fundamental that it has a name in commercial real estate. It is called a duration mismatch. On the cost side, WeWork's obligations were long and fixed. When it signed a 15-year lease, it owed that rent for 15 years in a recession, in a pandemic, in a market crash, regardless. The landlord does not renegotiate because your members left. The obligation is a contract, and the contract does not care. But on the revenue side, its income was short and cancelable. A freelancer paying month to month could leave with 30 days notice. A startup tenant that ran out of funding simply vanished, often without paying the final month at all. So the two sides of the ledger had completely different shapes. One side was a 15-year commitment carved in stone. The other side was a promise that could evaporate in 30 days. Think about what that means in a downturn. Revenue can fall by half in a single quarter as members cancel. But the lease obligations do not move at all. The company is contractually locked into paying rent on office space that nobody is renting from it. In finance terms, the business has high operating leverage pointed in the wrong direction. When occupancy falls, the fixed cost base does not fall with it. So a modest drop in revenue becomes a violent drop in profit. This is not a hidden risk. It is not a subtle one. It is the defining risk of the entire industry, and it has been for decades. It is the reason that Regus, WeWork's nearest twin, had been forced to put significant national subsidiaries into bankruptcy protection during the 2008 financial crisis. The flaw was not a secret WeWork was keeping. It was a published fact of the industry WeWork had chosen to enter. So WeWork was a real estate arbitrage business with a known structural flaw, competing in a low-margin industry that had existed for 30 years. A business like that, valued honestly, is worth a real estate multiple. And real estate multiples are sober. A property or leasing company is generally valued on its assets, its occupancy, and a modest multiple of its cash flow, often something on the order of 1 to 2 times annual revenue. These are not exciting numbers. They're not meant to be. They reflect a mature industry with thin margins and predictable cycles. Regus, doing the same thing at similar scale across more countries than WeWork, and, critically, actually turning a profit, was valued by the public market at roughly $4 billion. WeWork was valued at $47 billion, roughly 12 times its nearest comparable, a comparable that was, unlike WeWork, actually making money. So the central question of this entire story is this: how do you get the market to pay a technology multiple for a real estate business? The answer is language. You change what you call it. WeWork's leadership, led by co-founder and chief executive Adam Neumann, understood something important about how venture capital prices companies. Venture investors do not primarily value the present. A startup, almost by definition, has a thin present, small revenue, real losses. What venture investors value is a story about the future, and specifically, a story about a future in which the company becomes very large, very fast, at very low marginal cost. And here is the mechanism that makes this story worth money. The multiple an investor will pay on $1 of today's revenue depends almost entirely on which category they believe the company belongs to. The category is not a label. The category is the valuation. A real estate company that earns 10 cents per dollar of revenue is priced on its assets and its cash flow. It is worth, roughly, what it owns and what it reliably earns. A technology platform is priced on something else entirely: software, network effects, near zero marginal cost, winner-take-all dynamics. A true platform is priced on its imagined future scale, because the market believes that scale, once reached, is enormously profitable and very hard to dislodge. So consider the arbitrage. The same dollar of revenue, the same actual cash coming in the door, is worth $1 or $2 of company value if you are a real estate firm, and $10, $20, $30 of company value if you are a software platform. The revenue does not change, only the label changes. So WeWork simply stopped describing itself as a real estate company. The reclassification was not subtle. It was thorough, deliberate, and stated in the company's own formal documents. WeWork described itself not as an office provider, but as, quote, a community company committed to maximum global impact. Its stated mission, per its own filings, was, quote, to elevate the world's consciousness. Read that again as an analyst. That is the mission statement of a company that signs office leases. And the vocabulary was consistent. Across its public offering document, WeWork used the words technology and platform several hundred times. The phrase real estate, the literal, accurate description of what the company did, appeared far less. The document was not describing the business. It was reclassifying it, word by word. And the framing went deeper than mission statements. it reached into the operational language of the company. WeWork described its members not as tenants, but as users. The word a software company uses for the people on its platform. It described its buildings not as leased real estate, but as a physical network, as nodes, implying the same compounding value you find in a communications network or a marketplace. It spoke of the data it gathered on how people work, as though that data were the asset, and the offices merely the sensors. And it coined a proprietary financial metric, one we will come back to in detail. Taken together, the company presented itself relentlessly and consistently as an organization whose value lay not in the floors it rented, but in the software, the data, and the community it claimed to layer on top of them. None of this reclassification would have mattered without capital willing to believe it. A story only becomes a valuation when somebody writes a check against it. And the single most important investor in the WeWork story is SoftBank, specifically the SoftBank Vision Fund, a roughly $100 billion investment vehicle run by SoftBank's founder, Masayoshi Son. The Vision Fund was at the time the largest pool of technology investment capital ever assembled. Its mandate was scale, to find companies that could become category-defining giants, and to fund them so aggressively that competitors simply could not keep pace. Over several funding rounds, SoftBank and the Vision Fund put more than $10 billion into WeWork. And critically, this is the detail that matters most. Each new investment came at a higher valuation than the last. To see why that matters, you have to understand how a private company gets a price at all. In the public market, a share price is set continuously by thousands of buyers and sellers. It ticks on a screen, second by second. In private markets, there is no such screen. A private company is worth, quite literally, whatever the most recent investor agreed to pay in the most recent round. That single transaction sets the price for the entire company, including every share that did not trade. So if one large, motivated investor is willing to pay a higher number for a small new slice, then on paper, the whole company, every existing share, is suddenly worth more. So consider the incentive structure this creates. It is the heart of the matter. SoftBank had already invested billions into WeWork at lower valuations. Those earlier shares sat on its books at the price it had paid. Now suppose SoftBank invested again, a fresh round at a far higher valuation. That new, higher price does not only apply to the new shares. It reprices the entire company, which means it marks up the value of SoftBank's own earlier investment. Read that carefully. The investor setting the new, higher price was the same investor who most directly benefited from that price being high. There is no independent referee in that transaction. The buyer and the beneficiary are the same party. An outside observer might reasonably ask whether $47 billion was a market valuation at all, or simply the last number one enthusiastic backer was willing to write down. At the center of all of this was Adam Neumann. And it is worth being fair to him, because the fairness is part of the lesson. Neumann was, by every account, an extraordinary salesman, charismatic, physically commanding, genuinely persuasive in a room. People who were deeply skeptical, on paper, described leaving meetings with him convinced. That talent was real, and it was central to the company's rise. Neumann framed WeWork not as an office sublet business, but as a generational social movement. He spoke about reinventing how people work, then how they live, then eventually how their children learn. And the company acted on the rhetoric. It launched a residential arm, WeLive, renting furnished apartments with shared common space. It launched a private elementary school, WeGrow. The office company was, in its own telling, becoming a company about the whole texture of modern life. The narrative worked, in large part because Newman himself seemed to believe it completely. This is not a small point. A pitch delivered by someone who privately knows it is inflated tends to crack under hard questioning. A pitch delivered by a true believer does not. And Newman gave every sign of genuine conviction. He reportedly told colleagues that WeWork's valuation depended not on revenue or profit, but on, quote, energy and spirituality. He spoke openly of becoming the world's first trillionaire. He suggested WeWork would help solve vast global problems, from the welfare of orphans to world peace. To a sober analyst, reading a balance sheet, this kind of language is a warning sign, a signal that ambition has detached from arithmetic. But to a venture market in 2017, hungry for the next world-changing platform and afraid of missing it, that same conviction was not a warning sign at all. It was the product being sold. Now let's do the thing. WeWork's documents worked hardest to discourage. Let's look at the actual numbers. In 2018, WeWork reported revenue of approximately $1.8 billion. That is a real number, and a large one. Growth, in raw revenue terms, was rapid. But growth alone is not a business. In that same year, WeWork reported a net loss of approximately $1.9 billion. Read those two figures together, slowly. $1.8 billion of revenue. $1.9 billion of loss. For every single dollar of revenue the company brought in the door, it lost approximately $1. And here's the part that should end the conversation for a careful investor. The losses were not shrinking as the company grew. They were not converging toward profitability. They were growing roughly in step with revenue itself. The company was not climbing toward a profit, it was scaling a loss. Now, a defender of WeWork would object here, and the objection deserves a serious answer. The objection is this: plenty of great technology companies lost enormous sums in their early years. Amazon lost money for a long time. Many of the most valuable software firms in the world burned cash for years before profit. So why is WeWork's loss different from theirs? The answer is the single most important concept in this entire episode. In a true software business, early losses can be entirely rational. You spend heavily up front to acquire a customer. But once you have acquired that customer, they cost you almost nothing to serve, and they pay you month after month for years. The marginal cost of one more user of a finished software product is close to zero. The next user downloads the same code. That asymmetry, high cost to acquire, near zero cost to serve, is precisely what justifies burning cash to grow. You are buying a long, cheap, profitable annuity. But WeWork's costs were not close to zero. This is where the analogy to software completely collapses. Every new WeWork member required physical space, and physical space is not free and never becomes free. Each new desk required a signed lease on a real building, a renovation and build-out, furniture, heating and electricity, cleaning staff, front desk staff, and, yes, the free coffee and the beer on tap. The marginal cost of one more WeWork member was substantial, recurring, and permanent. The 100,000th member cost about the same to serve as the 1,000th, and that is the whole case. The economics of software, the economics that justify burning billions to grow, simply did not apply to WeWork. Not because WeWork was run badly, but because it was not, in any real sense, a software company. To blur this, WeWork's documents leaned heavily on a metric the company had effectively invented. It was called community-adjusted EBITDA. Let's be precise about what that metric did, because the precision is the point. EBITDA is a standard, widely used measure. It stands for earnings before interest, taxes, depreciation, and amortization. By stripping those four items out, standard EBITDA already gives a company a flattering view of itself. It is, by design, a generous measure of operating performance. Most sophisticated investors already treat EBITDA with some caution for exactly that reason. WeWork's version went considerably further. Community-adjusted EBITDA took that already generous number and stripped out still more: basic, unavoidable operating costs. It removed marketing expense. It removed general and administrative expense, the cost of running the company. And, most remarkably of all, it removed the cost of actually building out, staffing, and operating the office locations themselves, the central, defining cost of the entire business. In other words, the company asked investors to judge its profitability using a number that excluded the central cost of being WeWork. Through this metric, individual buildings could be presented as healthy and profitable. Measured by any standard accounting rule, the company as a whole was losing nearly $2 billion a year. One financial commentator memorably described the metric as, quote, profit before all the bad stuff. For years, none of this could be properly examined by the outside world. WeWork was a private company, and that fact is more important than it sounds. A private company is not required to publish detailed, audited financials for the public to read. WeWork's true financials, its full lease obligations, its governance arrangements, its founders' various side deals, all of it sat behind the wall of private ownership. The only people who saw the complete picture were insiders and a small set of large investors. And those investors, as we have established, were not neutral. They were the very people paying for the story to be true. In effect, the company was being valued by an audience that had bought tickets to the show. That changed in August 2019, when WeWork filed its S-1. An S-1 is the registration document a company in the United States must file with the Securities and Exchange Commission before selling shares to the public. It is a legal requirement, and it is, by design, comprehensive. It must disclose the real financials, the real risks, the real governance arrangements, in detail, in writing, under threat of securities law. The day the S-1 became public is the hinge of this entire story. Every event before it is set up. Every event after it is consequence. Because on that day, for the first time, thousands of people who had no incentive whatsoever for the WeWork story to be true could read the actual numbers. Independent equity analysts, financial journalists, portfolio managers whose job was to be skeptical with other people's money, short sellers actively looking for the weak point. And what all of them found when they opened the document was a gap, an enormous gap between the story the company had been telling and the business the filing actually described. Start with the losses. We've already covered them, but in the S-1, they were no longer a rumor or an estimate. They were audited, disclosed, undeniable. Nearly $2 billion lost in the most recent year. And, just as damaging, no credible, specific path to profitability disclosed anywhere in the document. The filing showed the loss, but not the cure. Then the lease obligations. And this is the single number that did the most damage. The S1 revealed that WeWork had committed to future lease payments totaling more than $47 billion. Now hold that number directly next to the valuation. Investors have been told the company was worth $47 billion. The same document revealed that the company owed roughly $47 billion in future rent. Its entire headline value was matched almost exactly by the size of the obligations it had signed. Then came governance. And this is where the document moved from troubling to almost theatrical. The S1 disclosed a series of arrangements between Adam Neumann and the company he ran. Consider three of them. First, Neumann had personally bought commercial properties, real buildings, with his own wealth, and then leased those buildings back to WeWork. Which means the company was paying rent to its own chief executive. His interest as a landlord, wanting high rent, sat directly opposite his duty as a chief executive, wanting low costs. Second, he had taken large personal loans from the company itself at interest rates far below what an ordinary borrower would ever be offered. Third, and this is the detail that became briefly famous, Neumann had personally trademarked the word "we." He owned it. And he then arranged for the company already named WeWork, already rebranding itself as the We Company, to pay him nearly $6 million for the right to use its own name. Each of these, individually, is a recognized governance red flag. Together, in a single filing, they painted a picture of a company run with very little separation between the founder's interests and the shareholders' interests. The $6 million trademark payment was, after the backlash, reversed. But the reversal was not the point. The point was that it had been proposed and disclosed at all. What happened next was extraordinarily fast, and the speed itself is part of the lesson. A valuation built slowly, over years, across many private rounds, came apart in a matter of weeks. The S1 was filed in mid-August 2019. By the end of September, roughly 6 weeks later, the IPO was dead, the chief executive was gone, and the company was fighting for its survival. Here's the sequence, step by step. As soon as the S1 was public, the financial press and the analyst community took it apart. And they did so quickly because the document had handed them everything. The losses, the duration mismatch in the leases, the invented metric, community-adjusted EBITDA, which was now openly mocked. The governance arrangements, the loans, the self-dealing, the trademark payment, the strange, grandiose mission language about elevating the world's consciousness. All of it was now on the public record, and all of it was analyzed line by line in public within a matter of days. The story had survived for years only because it had never been read closely by a hostile audience. Now it was, and it did not survive the reading. As that analysis spread, the people who actually mattered for the IPO began to react. An IPO is not bought by the financial press. It is bought by large institutions, mutual funds, pension managers, the great pools of capital that would have to commit real money to WeWork shares. And as those institutions read the S1, they began to signal what they were actually willing to pay. Their number was nothing like $47 billion. Discussion of the likely IPO valuation fell, and then kept falling. First the talk was of $20 billion, then 15, then 10 billion or below. The valuation was not negotiated down gently. It was repriced, in public, by an audience that had simply done the math. This is the central mechanism of the whole collapse, so it is worth stating plainly. The private valuation had been set by a small number of motivated insiders. The public market is a far larger, far more skeptical, far more diverse crowd, and it was being handed, for the first time, the actual document. The public market read the same business that SoftBank had valued at $47 billion and concluded it might be worth a fifth of that or less. With the valuation collapsing, the IPO became impossible, and it is worth understanding exactly why. If WeWork had gone public at, say, $10 billion, it would have done so far below the $47 billion its last private investors had paid. That would have instantly, publicly, confirmed enormous losses for those investors and would have forced a brutal markdown across SoftBank's entire stake. Going public at the honest price meant admitting the dishonest price. So in late September, WeWork formally withdrew its offering. The IPO simply did not happen. And days later, under heavy pressure from the board and from SoftBank, Adam Neumann resigned as chief executive of the company he had co-founded and built. With the IPO dead and Neumann gone, WeWork faced an immediate, concrete problem. And it was not a problem of reputation. It was a problem of cash. The IPO had not only been a way to crystallize a valuation, it had been the plan for raising the money the company needed to keep operating. WeWork had been burning cash at such a rate that by some estimates, it was only weeks away from being unable to meet payroll. The company that had recently been valued at $47 billion was, within weeks, at risk of running out of money entirely. SoftBank now faced a genuinely hard choice, one that has a name in finance: the sunk cost problem. SoftBank had already invested more than $10 billion into WeWork. That money was already spent. If WeWork now collapsed entirely, much of that $10 billion would be written straight to zero. It could accept the loss and walk away, or put in still more money to keep the company alive and protect what it had already committed. SoftBank chose to double down. In October 2019, it assembled a rescue package: new financing, a tender offer to buy out shares, and accelerated funding. A package that valued WeWork at roughly $8 billion. Sit with that progression, because it is the entire episode compressed into two numbers: $47 billion in January, $8 billion in October. Same buildings, same leases, same members, at the same desks, drinking the same coffee. No asset had been destroyed. No market had vanished. The business itself was physically almost unchanged. The only thing that had genuinely changed across those 9 months was the audience doing the pricing. A small group of motivated private investors who benefited from a high number had been replaced as the pricing authority by the broad, document-reading public market. That substitution of audience and nothing else is what erased $39 billion. And one final detail drew particular public anger. Adam Neumann, who had built and steered the company into this position, did not leave empty-handed. He departed with an exit package reported to be worth as much as $1.7 billion, even as ordinary employees faced waves of layoffs. In the years that followed, WeWork's story continued downward, and the way it did is the cleanest possible confirmation of the analysis. In 2020, the pandemic emptied offices across the entire world. Members canceled. Occupancy fell, but the leases, the long, fixed, non-cancelable leases, did not move. The pandemic struck directly, precisely, at the duration mismatch we identified in the very first scene. The theoretical flaw became a real one. WeWork eventually did reach the public market in 2021, but through a different, quieter door, and at a value a small fraction of the old 47 billion. And in 2023, WeWork filed for bankruptcy protection. The structural flaw in the model, visible from the beginning to anyone willing to look, had finally, fully arrived. So what is the durable lesson here? The part worth carrying out of this case and into the next one. The lesson is not simply WeWork was a bad company. That would be too easy, and it would not be quite true. WeWork's underlying business, flexible, well-designed, short-term office space, was and still is a real business serving real demand. Plenty of people genuinely want what WeWork sold. The lesson is narrower than bad company and far more useful. It is this: the single most important question you can ask about any company before you ever look at the growth rate, before you admire the founder, before you read the mission statement, is a simple one. What category is this business actually in? And then, does the price reflect that real category, or does it reflect a more flattering category the company would prefer you use? WeWork was a real estate arbitrage company. A competent one, perhaps, with a genuinely better product than its rivals. But a real estate company nonetheless, subject to real estate margins, subject to real estate cycles, and subject to the one known, published, inescapable real estate flaw: the duration mismatch. For a period of years, in a market that badly wanted to believe in the next great platform, it was priced instead as a technology company. And so the $47 billion valuation was never, at any point, a measure of the business. It was a measure of the story, and just as much, a measure of how few people inside a private market are ever actually permitted to open the document and check. When the S1 became public, nothing about WeWork physically changed. The building still stood. The desks were still full. The coffee was still free. All that changed was that the rest of us were finally handed the document and asked, for the first time, to price the company on what it was, rather than on what it said. In a market full of companies working hard to be seen as something they are not, the most valuable habit an investor can build is simple. Read the filing, price the business, ignore the adjective. If this is the kind of strategic anatomy you find useful, subscribe to Market Cap Stories. We will see you in the next case.